Are you a CEO and you're struggling to scale your business, aligning your finances for long-term growth? If so, you're going to want to watch this video. In this podcast, I sit down with Alix McKenzie, owner of Cyber CFO. She is going to share some insider strategies so that you can set up your business's finances for long-term success. Today, I'm excited to talk with Alix McKenzie. She's a fractional CFO and owner of Cyber CFO. Alix, can you tell me a little bit about your background and a little bit about your business?
Absolutely. Thank you so much, Ken. It's a pleasure to be here with you today. I'm Alix McKenzie, the CEO and owner of Cyber CFO. I provide fractional CFO services to small businesses here in Jacksonville, Florida.
Awesome.
Yeah, so just to tell you a little bit about myself, I have 6+ years of public accounting experience, specifically in audits of small to mid-sized companies across several different industries. However, I did specialize for 3 years specifically in commercial real estate.
Interesting. That's really awesome.
It was fun. A lot of work. So now what I do is take that skill set with my background in audit and help apply some of those concepts to the businesses locally here to Jacksonville. And today, I'd love to take you through the income statement and balance sheet areas that business owners often lack.
Before we get into that, tell me a little bit about what a fractional CFO is and the unique niche that you fill.
Absolutely. So we take on the full financial transaction cycles of a business. So when we break things down into transaction cycles, these can be things such as AR, AP, fixed asset management, categorizing transactions through bookkeeping, and helping clients plan for tax season.
Mm-hmm. And fractional means?
So it's like having a full-time CFO on staff, but you don't have to pay the price of a full-time CFO on staff.
Excellent. That's really exciting.
It is.
Alix, from a really big picture perspective, can you focus on the top 6 or 7 things that businesses need to focus on to have really good accounting? Absolutely.
So I think the first question to ask here is, what are we going to be using these financial statements for? And typically that breaks down into 2 different areas, and management will use them for making internal decisions, CapEx purchases, budgeting, those types of things. And then on the external side, we typically have lenders, investors, any kind of third party that needs to see your financial statements.
Okay. What part feeds into the business tax preparation?
So the tax preparation comes at the end of the year.
Okay.
However, throughout the year, we need to make sure that we're capturing all transactions that the business generates so that once the end of the year comes along, those financials are ready to go out the door to the tax accountant.
So you find that small and medium-sized businesses have this kind of accounting in place, or do you find it to be the exception? And what normally happens when tax season comes around when they don't?
Certainly. And this is something that I see often, is that when tax season comes around, sometimes the bookkeeper, whoever is managing, the finances, the business owner, may be a little bit behind on some of that financial reporting, just because maybe they haven't had the time to get to it. Or sometimes, as sad as it is, I see books get neglected by a bookkeeper where they sit for a couple of months and then they'll get in and do all the transactions. That's a dangerous game because it's all about the timeliness of the financial reporting and that data, because that's what we're using to make decisions. And if it's been 3 months, the data becomes less and less relevant as time goes on.
Harder to make really good, important business decisions that will drive profit for the business.
Correct.
Okay, awesome. So Alix, tell me about the top 5 or 6 areas that businesses plan to use their financials for.
Absolutely. And so this is going to showcase why financial statements are so important for business owners.
Awesome.
Because there's multiple uses. Once we have complete and accurate financial statements, now the question is, what are we going to do with them? So number 1 would be for internal decision making for business owners. So once we have the numbers in place, we can project for budgeting purposes to ensure that we have enough cash flow for any kind of capital expenditure that may be coming up, equipment purchases,
hiring an employee,
hiring an employee,
renovating the office. Okay.
Yep, correct.
So you mentioned internal, Alex. So what would some external uses be?
Absolutely. So when we go to fund these capital expenditures, typically we need money from somebody. So the financial statements will go out to investors, lenders, whoever may need them to make sure that your financial reporting is correct and that they can make their decision based on them.
Based on good financials, accurate information. So whether we're talking to investors, angel investors, business lenders, your books are in order and they love that.
Yes.
Awesome. And then you mentioned processes and procedures and documentation.
So this is a really big one for businesses, is putting together formal internal narratives for any kind of financial reporting processes that are in place. Because this is going to ensure proper segregation of duties and lay out who's doing what within your business when it comes to finances. So for example, we would never want to give somebody access to the accounting system who's able to make cash disbursement on your behalf, because the risk would be that they could eliminate the entry from the accounting system while taking the cash out, and then the transaction wouldn't be reported. So we'll go over some checks and balances that can be implemented to mitigate that risk.
Yep. What about audit and compliance?
Absolutely. So sometimes with lenders or investors, they want to ensure that that information that they're receiving to make those business decisions is accurate. So they'll hire an independent third party to come and look at the financials and review or audit them. And this is a point where the ducks need to be in a line. So leading up to this point, there needs to be a cleanup of the books because if the auditor starts finding the statements within, it will increase your risk. They'll have to make more selections and request more documents, which is typically going to extend the timeline and cost more money and add stress.
Yes, which takes away from what they want to do for their core business.
Correct.
Okay. So in a fintech business that we had at one time, I remember when we were applying for a small business loan, that the financials were really important. And since we had really good accounting, we're able to pull that information and have it available to answer all the questions that the lender had for us. Would that be an example of what you're talking about?
That would be correct.
Okay.
And I also have some nightmare stories from audit as well. Where, for example, as auditors, one time we went in to audit somebody's books and we noted that they didn't have any kind of accruals or accounts payable recorded on their balance sheet. And so immediately as an auditor, that's a red flag. We know that there's not proper controls or review over that end product that's going out the door, especially if it's coming to us. So in that case, that can lead to comments on the management letter regarding those controls and a lack of processes and procedures. Another one, an audit that I often saw missing was that formal internal control narrative, where it documents the segregation of duties between employees or owners, and it documents the final financial review as well. There are different areas that need to be addressed within the narrative, but those are a couple just to name a few.
Yeah, I could see that it would be quite important. And we talked a little bit about tax planning. You don't do the tax planning or the tax preparation, but you want to make sure that their books are in great shape. So when they're getting ready to do their taxes, they can do it much more fluidly.
Correct. And one of the biggest misconceptions about tax time is that you can retrospectively find those savings. You really need to be proactive about it prior to year end and plan throughout the year with that data that you get from your bookkeeper, keeping your financials up to date so that you can make a capital expenditure, for example, toward the end of the year if you need to lower that tax bill. That's just a specific example, but there are different strategies and where you can invest in the timing prior to year end to get that lower. But those are types of things that would need to be identified prior to year end.
That's a great example because that could have a big effect on their tax bill for the prior year.
Huge.
Yeah.
And if they were going to do it anyways,
just waiting a few weeks could cost them thousands.
Really cost them.
Wow.
So important.
Which would more than enough pay for your services for the entire year.
Correct.
What about accounting systems and chart of accounts? And, making sure that the employer has a good system for recording everything so that when you come in, is that something that you help with or?
The chart of accounts and account numbers are all very important because it lays out how the data is presented on the financial statements.
Okay.
So sometimes people like to see things a lot more high level where they might just have sales, cost of sales. Whereas other people might want that broken out a little bit more. So we might have sales by revenue stream, which is something that I typically recommend so that we can track profitability by revenue stream or by client. So the way the data is input into the system matters for how it's going to come out of the system.
Right. And you help them set that up.
Correct.
Okay. That's a really great overview. Alex, I know you wanted to dig a little bit deeper into some of the other accounting areas. What are some of the things that you would like to highlight now?
Absolutely. So I'm thinking that we start with the balance sheet.
Okay.
Yeah. And let's start with the line item that typically comes first, which is
cash.
The most liquid asset. So cash management is really important. And I see lots of fluctuations in cash flow in businesses. Sometimes there's seasonality. And cash is such a high-risk asset due to that liquidity. Okay. So it's very important that we have proper internal controls surrounding cash. Earlier, I had mentioned the segregation of duties.
And logically, what flows after cash?
So the next is going to be the cash that's about to come in. So that would be accounts receivable. Mm-hmm. So accounts receivable and revenue are kind of tied together.
Okay.
Since it converts to revenue on the P&L once it's coming in. And one report that is really critical in this area is an accounts receivable aging report. So this is a listing of all of the outstanding invoices and how long they have been outstanding.
Okay.
And so if something's been on the receivable aging report for 90 plus days, for example, we need to start questioning if that amount is still collectible.
Okay.
And so when it's not, and we come to that decision, we need to take it off and just write it off as a loss.
Okay.
Another really important thing is to ensure that this receiving report always ties back to the balance sheet. Otherwise, we may be missing items or something may have not been properly recognized when the cash came in.
That makes a lot of sense. What's the next area?
The next area is going to be a small one.
Okay.
So we group a lot of things into other assets. Typically, one of those items will be prepaid expenses.
Okay.
And so what this means is that, for example, if you prepaid a giant insurance policy in November of 2023, for example, really that expense needs to be matched up with the period that that contract relates to. So we would only record 1 month's portion of that total balance to 2023, and the remainder would get recognized in 2024 as the contract comes closer to the expiration date.
Okay.
This is something that we call the matching principle in accounting. Okay. So as accountants, we always try to match the revenue and the expense within the same period that it occurred.
Okay. Awesome. That makes a lot of sense. So you talked about other assets. What about fixed assets?
Fixed assets. So those are going to be the bigger purchases.
Okay.
And typically a company within that internal control narrative will have some kind of policy as to a cutoff amount where whether it's going to be expensed on the P&L or capitalized on the balance sheet. In which case, if it is capitalized on a balance sheet, say you buy a truck for $10,000.
Okay.
it's going to go on your balance sheet as an asset. Now, with that matching principle, we need to match the expense of that asset with the useful life that it's going to last. And so with that process, we calculate something that's called depreciation. There's a couple of different methods to recognize those costs for
straight line or accelerated or those.
Correct. Yeah. And based on the time value of money, the accelerated method is typically used for tax purposes, whereas the straight line is typically used for GAAP or book value.
Okay. Excellent.
And then moving on from the assets onto the liabilities, one of the first areas is accounts payable and accrued expenses.
Okay.
And these are so critical because this is the money for services that you may have received but have not yet paid.
Okay.
And so that's why it's kind of a liability, or it is a liability.
Right. Well, that makes a lot of sense.
So cutoff is a really important aspect to accounts payable. So when we get to the end of the year and we have all of these contractors who have provided consulting work for our company, for example, and they just haven't sent us the invoices yet.
Okay.
We need to figure out how much money is going to go into our accounts payable or accrued expenses for those kinds of costs that we now owe at period end. Okay. And the difference between accounts payable and accrued expenses, a lot of people question this. Okay. What is the difference? Yeah. So an accrued expense is typically something that you need to estimate. So things like utility bills, where the invoice almost straddles a cutoff date. Okay. So we'll see this for payroll too, where the typical 2-week payroll might not end exactly on 12/31, or it was paid out in the beginning of January. And so we need to make sure that we accrue for that payroll expense at year end.
For the partial amount that...
Right, for the portion of that expense that relates to the period in which it was performed.
Makes sense. Got it.
Moving on to some of the longer term liabilities, typically we'll see like lines of credit, long-term debt on the balance sheet. And so these items, similar to how fixed assets get depreciated, these get amortized. Okay. So the liability will reduce over time as you pay down the principal and interest on that loan. And so we just want to make sure that that gets on the balance sheet, as well as the year-end balances on any kind of loan need to tie back to the balance sheet. So the underlying schedules all need to tie back. Okay. So moving past the liabilities into equity. So this is going to be owner's money that's coming into the business or coming out. Going in would be a contribution to your business. Coming out would be a distribution.
Like an owner is taking $50,000 out of their savings to fund the business in that year, to invest in his own business. Is that the example?
That would be an example of a contribution, yes.
Okay.
And then a distribution would just be the opposite of money being paid out to owners. And typically we would also have some kind of policy in place if there are multiple owners on when money can be taken out, who gets paid first, as well as any kind of approvals for distributions prior to them being paid.
Okay, excellent.
And now we can move on to the income statement, which is really the bread and butter of where we make a lot of these decisions.
So you're talking about revenue, I guess, at this point?
Yeah. So we'll start with revenue. And so it's critical, like I had said earlier, to input data in the way that you want it to be output. So when we record revenue transactions, we want to be identifying what revenue stream did this transaction come from? Is this revenue within the terms of whatever contract it may have come from? Okay. And another example would be tracing revenue directed to a project. Okay. This is going to be critical for calculating that profitability by revenue stream, by project, by customer. We just have to make sure that we input it in the way that we want it.
Sounds great.
And moving on to the expense side, this is also holds true, is that we want to make sure that we're tracing expenses to that specific project so that we can see what the margin was on that project specifically.
Excellent. Boy, that's a lot of great information, but how do I make sure that it's being documented and tracked accurately?
That's a great question, Ken. And this is where it's so important for businesses to have that formal narrative of all of their processes, procedures, and internal controls around financial reporting. So at the end of the month, for example, we need to ensure that all of those back schedules on the balance sheet tie back, that everything's been captured within the accounting system. We perform reconciliations to ensure if that data has been collected properly. And then this narrative will also outline any kind of segregation of duties. It should outline who's performing the duty, their title.
So is that something that a fractional CFO would also help a client do?
Certainly. And as businesses are scaling, they often struggle with this and haven't prepared those processes and procedures prior to when they scaled. So now they're almost scrambling to get this together for whoever may need it.
They do it after the fact, and sometimes it's too late. They have risk.
Right. And I would recommend that this is something that is kind of ongoing as you scale. It's always being adjusted and fitted to what your business needs are.
Yeah, so if they're taking on new product lines, they need to establish new processes and procedures for their accounting.
Correct.
Okay,
yeah.
Great. Let's talk about cash management, Alix. What are the key procedures you recommend for managing revenue and cash?
Since cash is such a high-risk area based on that liquidity that we discussed earlier, it's critical to have the proper internal controls around your cash management.
Okay.
This includes segregation of duties. So whoever is actually handling the cash cannot have access to the accounting records because they could pick from the cash and then delete it from the accounting record, for example. Another procedure would be to reconcile bank accounts and credit card accounts on a monthly basis. This is going to ensure that everything that actually went out of the business via that account is captured within the accounting system. Once that reconciliation of the cash accounts has been prepared, then it needs to be reviewed by somebody who has maybe an owner or upper management to ensure that all of those transactions are valid and that the ending cash balance per the reconciliation is tying back to what's on its statement.
Okay. So recently I sent you a link to a YouTube news article about a company where the bookkeeper, they absconded with a lot of money from this insulation company. This was a very successful company. They had a large warehouse, and the initial theft was just a small credit card purchase. And it ballooned into something so much bigger that it almost bankrupted the business. Is that what we're talking about here?
That's exactly what we're talking about. And so just to give a diagnostic there was not proper segregation of duties. If she had a credit card, she had access to that cash management and then also the books. And so she could have changed the transaction to make it seem like it was for something else. And then another thing there would be that the owner should have been reviewing what she had been preparing in detail. The involvement from upper management is very critical as well.
Okay.
Oversight.
From a banking perspective, the thing that I would like to add to this part of the discussion is most business banking, online banking, has authorizations, entitlements, different ways to approve all kinds of transactions. So it's aligning those processes and procedures along with the right settings on their business online banking.
Correct. So accountants should only have view-only access.
Okay.
They shouldn't have actual access to the cash without proper approvals.
What about the accounts payable person or the person doing payroll? Would that still apply?
Yeah. So there can be different procedures that are put in place for, say, an accounts payable if there is cash management.
Okay.
For example, we could use a purchase order. So somebody fills out a purchase order for what they need. That gets sent to the owner for approval. Okay. And then once the approval is done, they can then pay that expense out of AP.
Okay, perfect.
And if there is any kind of inventory coming in, it's also critical that there is a three-way match done between documents to ensure that the invoice matches what was received on the receiving report and matches what went out the door for the payment.
Okay, makes sense. Thank you. What about ensuring that businesses have their cash working for them, maybe their idle cash that they don't need right away for the current month or for the current payroll? How can they make sure that that's working?
So for businesses that don't need immediate liquidity, then they can take that cash and make it work for them. So investing it in some kind of money market or investment account is typically recommended so that it's not just sitting there. It depends on what your cash flow is, your needs short term, to determine what you would put into a money market, how much, what percentage of your overall cash. Okay.
So by having good accounting, they would then know what their cash needs are for the next couple months. And then that would tell them what portion of their account they could sweep over into an interest-bearing account, for example.
Correct.
Okay. At this point, Alix, I'd like to drill down a little bit deeper when it comes to revenue and accounts receivable. Why is it important to differentiate between products and services when managing their revenue?
Yep. So different product or service lines when recognizing revenue is critical because not all revenue is going to be recognized the same. So that could be a reason why it's broken out. They have contract revenue and then product revenue, for example. And so since those have different costs associated with them as well, we want to make sure that we're matching up as best as possible so that we can calculate margins based on each from a segment of how we're generating our revenue.
Okay, excellent.
And then since revenue is so intertwined with accounts receivable, it's really important that we're monitoring that accounts receivable aging report for those long outstanding items of 90 plus, 120 plus days to assess for that collectability, and as well as managing the cash coming in, making sure that it is collected. So something, for example, that I typically see is that larger companies, for example, may delay payment for as long as possible because when it's on a mass volume, that cash they take and invest is short term and it gives them a return. So if your payment terms are net 30 days, they're typically probably going to wait 30 days to pay you. Something I've seen in accounting is that they'll give them an incentive to pay sooner with a discount. So, for example, a common one would be 210 net 30. So that would mean that you would receive a 2% discount if paid within 10 days or the full amount within 30 days. And adjusting these payment terms can affect your cash flow.
Okay, makes sense. Next, let's talk about business assets, such as fixed assets. Would that be something that would be important to talk about for this video?
Yes. Fixed assets, it's important when you're purchasing them to make sure that they're properly recorded. So we need the purchase documents to ensure that the amount that was paid for the equipment is on the books and then when we purchase a fixed asset, it needs to go on the books at the proper amount. We need to estimate a useful life for that asset. A salvage value that at the end of this life, what do we think that the asset will be worth? And then from there, depending on the depreciation method that's being used, we can calculate the depreciation with those inputs. Really important to keep a fixed asset listing. This lists all of your fixed asset, the useful life, the date purchased, the date disposed of, which should all tie back to the underlying documents, as well as your depreciation. So with the depreciation, you're also going to have a balance sheet account called accumulated depreciation. So this is a contra account to the asset. So as we recognize that expense on the P&L via the depreciation, that expense will offset on the balance sheet the price of that asset. So for example, if we put an asset on the books for $10,000, it's 50% depreciated. So when we say that we're going to sell it for $2,000, that would be our salvage value. Then we have $10,000 minus the $2,000, and then we need to divide that by the useful life. So now we're at $8,000 for the purchase price minus the salvage value.
Okay.
We estimate that it will last for 8 years.
Okay.
Then we would record depreciation expense for $1,000 per year for the next 8 years.
Okay.
So if we're 50% of the way depreciated, then we have an accumulated depreciation of $4,000.
Yep.
That offsets that asset purchase of $10,000. So the book value of that asset would be $6,000.
So yeah, $6,000.
Yeah.
Because of the remainder value. So we've talked about a lot of moving parts, a lot of finances. So in my mind, I'm thinking, boy, that's a lot of information to track. But the accounting systems will be tracking a lot of these things simultaneously. You're just breaking it out so that we can understand it better. Did I say that fairly?
It depends on the accountant. Some people do their own calculations. Some people have the fixed asset software that manage that for them.
Okay.
If their business is capital intensive and they have a lot of fixed assets, then a software would certainly be recommended to track those and calculate your depreciation every year. But it's very important to verify that the inputs going into that system are correct and tied to the underlying documentation that supports it.
Okay. Is that something that you do, or do you train an employee within a company to keep those things up to date?
We do fixed asset management. So with that, we would obtain those documents, estimate the life, calculate the depreciation for the client, and maintain a fixed asset schedule that has proper review at the end of the month to ensure that it's always tying back to the balance sheet.
Wow, that's really good. That was a really good discussion about fixed assets. Thank you very much. What practices do you recommend for businesses to track the accounts payable and the accrued expenses effectively? And how does reviewing trends help manage cash disbursements?
Yeah, this is a great question. So there are a couple of procedures that can be performed. The biggest concern here is completeness. Because these transactions aren't on the balance sheet, we have to go look for them and record them. And so where do we look? And when we have that past data tracking expenses by month, we can see who you paid every single month, and you know that we can probably bet that you will be paying them again this month.
Right.
And so with that assumption, we need to verify that and put it onto the books. Another procedure that can be performed is obtaining the January bank statement, or whatever month follows your cutoff period, and looking for any cash disbursements that may have related to the period prior.
Okay.
So if the cutoff is 12/31/2023, then we would want to ensure that in January, from those cash disbursements, that anything that related to December of 2023 is recorded.
What can business owners do to make sure they have a complete schedule of the accounts payable and accrued expenses at the end of the period? Or did you already?
And any kind of accounts payable schedule that's put together will need to also tie back to the balance sheet.
Okay.
So oftentimes these things are prepared outside of the accounting system.
Mm-hmm.
However, they need to tie back to the entries and what has been booked in the balance, ending balance on the balance sheet.
Now, is this important for investors as well?
Correct.
Okay.
For example, if in December you had $400,000 of payroll, that in a 2-week period, say 13 out of those 14 days related to December of 2023, a potential investor is going to want to know that you owe that money in January and that it's been recorded on your balance sheet for them to see.
Awesome. So, Alix, how do you help businesses manage their debt and their equity?
Right. So both of these items, since they are on the balance sheet, as well as the fixed assets, are going to have a procedure that's called a roll forward.
Okay.
And this takes the beginning balance of your balance sheet, since the balance sheet is a snapshot of your financial position at one point in time.
Okay.
So we need to take the beginning balance and then any activity that's impacting the balance account for example, if it is equity, any kind of distributions and contributions that are then going to get us to our ending balance of equity. Okay. And so this roll forward ensures that everything that has occurred is captured for the period, and that ending balance needs to tie back to the balance sheet.
Have you ever run into situations with companies where these things didn't line up and the problems that it caused?
Yes. When back schedules don't tie to the balance sheet or any kind of summary or the income statement, it will have pushback. So as an auditor, we need to, it's management's responsibility to prepare the financial statements. So we would push that back onto them. So they would have to go through and clean up and give us any kind of reconciling items that may have not been included to get that balance to tie back to the balance sheet. As an outsourced CFO, not an issue. Because that's already been prepared.
Awesome.
Properly.
Alix, how do you help prepare clients for audits to ensure compliance with accounting standards?
So there's a couple things that we do. First, we'll probably be making sure that all of those back schedules that have been prepared tie back to the balance sheet.
Okay.
There's nothing that needs to be reclassed. All accounts payable have been captured, accrued expenses, any kind of liabilities that we got. All the fixed assets onto the books, accounts have been reconciled. And so once you have the complete financials, it's also so critical to ensure that clients have the proper underlying documentation that they need in order to support everything on those back schedules. As an auditor, we pick selections from the transactions and then request that documentation. So it's important that our clients have that ready and available for them when somebody needs to see it. And staying organized with the documents is critical for that from the gate, because there's a lot of receipts, a lot of invoices, be high volume of items that are requested and that need to be retained for those purposes.
Okay. Is there anything else that you want to add to the risk management portion of accounting?
Yeah. One thing that I've seen that is very effective is having some kind of authorization matrix within your organization. So this ensures that the people who have the authorization to approve these transactions are outlined and clear. So typically this will outline who it's prepared by and who has authorization to sign and approve contracts, customer contracts, purchase orders, approvals for really anything payroll, anything material.
Alix, could you tell me a little bit about the software, the impact of software when it comes to accounting?
Yeah. One of the most important things about software is that they integrate.
Okay.
There's nothing worse than when two systems don't properly speak with each other. So just ensuring that whatever software you choose for your practice management, payment collection, integrates with the accounting system where necessary.
Inventory systems?
For example, an inventory system.
What about payroll?
So there's a couple different options for payroll. Typically, it'll be with a third-party service provider, such as like ADP.
Right.
And so when it comes to the entries being booked in the accounting system, if it's all integrated into one platform, then that payroll entry gets automated. However, I've seen typically it be with a third-party service provider. We obtain the reports and then book the entries that way.
So as a CFO, when you're looking at all their accounting and all their processes, you're trying to make sure that they have the right software in place. It's integrated to do all the functions that they need to be successful, it sounds like.
Correct.
Okay. So Alix, how is Cyber CFO leveraging AI to automate accounting processes and streamline operations? I know this is something you're really excited about.
Yes, it is. And Internally, we've started applying AI to our own processes and procedures. So from the get-go, out of the gate, we documented who does what, how they do it, how often they do it. And now we can plug that as an input into an AI software that can analyze the processes and procedures for us to identify any holes, weaknesses, as well as integrate chatbots for team members. So instead of those repetitive questions that staff may ask over and over again, now they can go to the chatbot and ask, and it will be able to give them a response based on those official processes and procedures. Having an AI policy for your organization and having employees sign that so that you can regulate what data, and they know what data can and cannot be put into these systems. So it's confidential data, cannot be shared. So anything that's input needs to be stripped of anything that would relate or direct that data back to the client.
And it's important to know the AI provider, what their limitations and their restrictions are for saving data and using it externally.
Correct.
Okay. Thank you, Alix, for all these valuable insights. I'm sure the audience have learned so much and has gained a lot from it. So thank you so much. If people want to learn more about Cyber CFO, how do they get in touch with you?
Call me, beat me. Go to cybercfo.co and my contact information is there.
Well, that's easy.
We also need to include some kind of disclaimer that this list and what has just been discussed today is not all-encompassing, and to consult with a professional prior to making any kind of actual business decision.
Yes, this was generic. We wanted to do top level, touch on some important things that businesses need to be conscious of. Because often businesses, especially in the first few years, they neglect a lot of these things. And we want businesses to be successful. And that's what you're so good at doing, helping businesses get their house in order. We've talked about that a lot. You provide so much value that you really are helping these businesses to be set up for success. I'd love to see that.
Thanks, Ken.
Yep. This was great information. I hope you gained a lot from it. I'm sure that you have. If you're an entrepreneur, if you're a business owner, you'll definitely want to get in touch with Alix about some of these things. Also, if you're a business owner or entrepreneur, ambitious, career-minded person, and you're thinking about starting a business, I would love to talk to you. I help individuals such as yourself and couples get their financial house in order in such a way that they can thrive in their family, in their marriage, and in their business. So I hope that you'll reach out to me if that's an area that you need help with as well. Thank you so much for watching this video. Please like it and subscribe to this channel. And there's going to be a lot more videos like this coming to you in the future. Have a great day.